I'd like to kick off. Ron, let's start with you. You talked about the consumer opportunity. Could you talk us through which consumers that you're actually selling product to? Is it really just a prime opportunity? Are we going to see any expansion beyond just prime? Isn't that the growth area? Because there can only be a limited amount of prime opportunity out there, presumably.
So the question is, what is the opportunity? And you're absolutely right, it is limited. But the good news, it's limited to $2.7 trillion of opportunity. So for Prosper, we're 640 minimum FICO, and we're going after those three types of borrowers, the debt consolidation, the large purchase, and that individual that's an entrepreneur. But the point is well taken. As we get better at data, we can go down in FICO, and we can look at new ways to do borrower analytics with looking at two people, perhaps a spouse, or looking at people's assets. So the opportunity here really is big in front of us. And if you look at us at $2 billion and Lending Club at $5 billion, it's teeny, right? If we can get 5% of this total addressable market, it's a massive opportunity.
But your colleagues, I mean, as far as I understand it, I'm sorry, I'm a mere Englishman, so we can't understand these FICO scores. But 660 is the cutoff point. It's roughly about
640.
right. 640, yeah. Is there good business to be done at 600, 580, or am I using the FICO scores wrong?
Well,
your colleagues on.
There are platforms doing it. I'm happy to turn this over. I think it's all about your analytics and your pricing and risk, if you can show the data behind those numbers. But FICO is just one of the things that we use. It's just one of 500 points.
At Puriform, we go down to 600.
Okay.
And I would just like to remind Ron that the pie is very big, and he doesn't need to try and go and eat the pie.
It's your bit of the pie.
That other people are very interested in gorging on. But depending on how you size the market, you're looking at anywhere from 30 to 50 million borrowers out there who are in the low 600 to mid 600 range. And it's been certainly a target market for Puriform because we do in fact believe that Prosper and Lending Club are most definitely looking at the near prime market, but are still focused a little bit higher than we are.
Mike, I'll just get your perspective on this. I mean, do we have to concentrate on prime, or is there money to be made at the kind of 640 to, well, I don't know, 580, something roughly in that area?
No, 600.
Yeah, okay. I'm pushing a bit lower there. What's your take on this?
Well, we've sort of stuck with the tried and true FICO of 660 and above, and I think that as the market matures, as time continues, a lot of these platforms will be collecting more meaningful data to be able to look at big data and look at outside statistics, which will make us more comfortable in going further downstream. So we're taking a more conservative approach for, quite the same reason that Ron pointed out, is that there's just a very large pie there right now. And we'd rather have more predictable metrics to use that have, 25, 50 years of back-tested data, as opposed to trying to figure out more esoteric types of attributes that might not be associated with very large, meaningful populations of fully matured vintages in the United States.
That raises a question. I know that the regulators in the UK have started looking at this as well. They've done it with the payday lenders in the UK, where they've effectively ripped up the rule book in terms of assessment of risk. Now, your different markets, payday lending, very different market. But your reliance on conventional risk metrics, are you having to add big data in? Are you trying to enrich that data so that you've more than just the standard credit scores? If you could talk us through, because I think a lot of institutional investors will go, well, okay, I understand all of this, but how will it actually appear?
So at Circleback Lending, we also don't look at just FICO. In fact, it's not the primary indicator of whether or not somebody's likely to default or not, but it is a very important one. We look at a lot of other attributes within the credit profile, and as I said, we're starting to look at using big data and other alternative sources of data to enhance what we're doing, but not rely too heavily on it until we, feel comfortable enough that the statistical, the numbers are there and it makes sense to start relying upon it. And I think that's only going to happen with more time, more scale, more sharing of data from the populations that we're underwriting to, right? Because when you look at subprime, near prime, there's a lot more data available for much longer periods of time because you have a lot of the subprime lenders out there that are accustomed to using that data. So for those types of populations, it makes a lot more sense, at least in our mind right now, we'll sort of take a sit and wait and use big data to enhance, but not to lead our decision and risk-adjusted pricing. So.
I want to bring Oren in here because this is an interesting point. Because actually, at PAVE, you are having to think outside of the traditional credit box because you're dealing with recently graduated students. Now they have credit ratings, but I'm guessing probably not great credit ratings. So you're probably having to do this kind of much harder work, big data work, to actually analyse whether or not somebody's a proper credit risk, aren't you? Can you talk us through how you analyse risk?
Sure, yeah, exactly. So at PAVE, we're focused on really the millennial demographic. So those are, the definition varies, but broadly speaking, it's people who are born after 1977 up until about 1990. And what we're doing is very much going beyond FICO.
Yeah.
So we're trying to understand really cash flow. That's a big part of us. What's the earning potential and what's the employability of any given individual? Because that, we believe, is a better predictor of risk than looking at FICO, especially for people with thin files. So we look at factors such as education, such as job history, potential job history, and other sorts of data points, even things such as telephone bills.
Right.
So, we very much believe that FICO, in certain cases, especially for thin files, either excessively penalizes or under-penalizes. So we do build our own score, which we think enables us to actually look at near prime and see and kind of look at those people who are going to ascend FICO-wise over the next few years.
And are you finding that there is real potential? I mean, talk us to the numbers that you're finding. Are you finding a lot of people who are technically subprime? It's not quite the same.
Yeah, I mean, it's interesting. A lot of our borrowers come in around 680 to 700. Okay. And when we look at why those scores from a FICO perspective, it's for just ridiculous reasons. So you'll find people getting landlord inquiries and dinged, multiple points in their FICO when they're just looking to rent a place in New York. Or someone who took a store card out at Banana Republic because they wanted the discount, put $25 on there, forgot about it, or $100 on there, forgot about it, has made perfect payments on all their other credit cards, yet again has been penalized excessively. So those are the type of adjustments we're making to FICO, and then when we look at their education and earning potential, we say, actually, this young person has a pretty good credit, and the thin file is really kind of harming his or her potential to access reasonably rated paper.
Peter, I want to bring you in at this point. I mean, you've got a good big picture view here. It strikes me, and correct me if I'm wrong, but institutional money coming into the consumer loans territory, already big player and platforms like Prosper and Lending Club, they're going to push down the yield, aren't they? And effectively, we're going to see the yield come down. Correct me if I'm wrong. I mean, let's have a debate about this. And actually, maybe the more interesting place for institutional investors and the more sophisticated private investors is to play a little bit higher up that risk spectrum, where you are going to get closer to the numbers that institutional investors. Because I imagine, look, let's be honest, if I'm an institutional investor and I'm going to get what? I'm being unfair, maybe 5, 6, 7%. I think, okay, but I'd actually rather play with a bit riskier stuff up at 9 and 10.
Well, it all depends on who the institutional investor is, obviously. If you're talking about hedge funds, then sure, they don't want to play down in the 4 or 5%, but there's plenty of banks that are coming into the space now. There's other like pension funds. They want something that's got very low volatility. So they're the ones that are really taking these lower risks. But to your other point, I think yes. That if you look, I mean, you take Prosper's data. You look at like 2010, 2011 returns. They're substantially above where they are today, and part of that is there is so much investor money. The average interest rate of Prosper was 20% back in 2011, and now it's around 15%. So that's a big it's a big delta, a big shift, and part of that is because there's so much investor money. Now the investors, the hedge funds, they still want yield, and they're extremely hungry for volume, and they're looking at alternatives. Like they're looking at some of the UK platforms and European platforms as well.
Where do you think, again, with your kind of that big picture hat on, where do you think the sector's going to go in the next few years? I noticed that Ron studiously didn't give us where he thought that big number, where that big number was going to go to, in the next few years. Come on, where do you think it's going to be?
Well, I mean, I think the doubling. I mean, Prosper's had a ridiculous run this year where they were growing at like 30, 50% a month. That's gone, I think, probably forever. But I think Prosper's probably going to do $4 billion next year. and I think Lending Club will probably do north of 10. And so I think, and that's where you're going to do. I mean, I feel like there's other, you've got like Circleback Lending.
Yeah, I was going to ask.
$500 million deal.
Yeah.
There's so many new players that are opening up now. I think this industry next year is just in the consumer space, it's probably going to be a $15+ billion industry in this country.
I mean, when I trained as an economist many years ago, and I remember my academic always telling me that the first big pioneer, the disruptor, is never the one that actually survives in the end. And that 3 or 4 years down the line, everybody's forgotten the name of the pioneer and the disruptor. So at the moment, everybody knows Lending Club and Prosper. Are any of these guys here basically going to overhaul them? I mean, who should we be watching out for?
Well, I'm sure you'll have all these guys say we should be watching out for them.
Yeah. Well, I will. I'll check them in a second.
I know I hear about platforms that are in the process of being launched. I mean, there's a couple of people that I know that want to launch companies that are focused on retail investors. That are focused. They're going to have an S1 registration like Lending Club and Prosper had. Like these other guys are focused on accreditors. So I think. Yeah, I mean, I think it's too early to tell, but in 10 years' time, in 5 years' time, I think Lending Club and Prosper are still going to be the two big players in business, but in 10 years' time, likely not. Likely someone who hasn't even started yet.
I saw to jump in, I saw in the UK, I'm not sure how recent it is, but there was a peer-to-peer lender lending against pocket money. I don't know if anyone saw that.
Pocket money.
Pocket money.
Excellent. Well, I'd say we'd do well with my kids.
You have to be 3 years and older to qualify, but you can actually borrow against your future pocket money. That's an interesting.
Well, I've never thought of that niche. Yeah.
I mean, that sounds like the classic, when the taxi driver is telling you about all the real estate he's buying.
Sell at that point. So where are you going to be, Greg? Talk us through your transaction flows at the moment.
Well, so I just want to make one other point first. I think we should also just keep in mind that, quantitative easing 1, 2, and 3 has really been a rocket fuel for this industry over the last couple of years. And last week, with Janet Yellen finally putting that to an end, nothing has happened yet in the credit markets. The curve still pretty much looks the same as it has before. But I think in the intermediate term, that will start affecting credit dynamics. And to your question of, where is pricing going to go? I think the honest answer is nobody in this room knows, because we are truly in unprecedented times now, first with the QE and now with QE being rolled back. But I think one of the great points that Ron made was the idea of not just being focused in on price, but customer satisfaction and appealing to millennials who think very, very differently about their relationship to brands. And the large money center banks are not doing a particularly great job of building that brand loyalty to millennials.
I'll quickly ask you all your views on this. If we see interest rates go up by, say, 0.5% or 1%, and personally I think that's probably the most it will go up, but maybe I'm wrong. Do we think that there will be a big increase in defaults at that point? What do you think the default rate will be? Let's go through along as we go along.
I think it depends on the nature of the economy. If rates are going up without real economic growth, then obviously defaults are going to go up. If rates are going up as a reflection of economic growth, then the default characteristics that we've seen may not change significantly.
Just robustness testing, when you build, I'll ask each of you this, and your robustness testing, where do you think the upper envelope for defaults in the worst case scenario is?
Well, I mean, everyone points to credit cards. I'm not sure that that's the credit cards during 2008 as an example, but I certainly think high single digits would not be unreasonable.
All right, what about you? I mean, talk us. I mean, you've securitized. There's lots of securitizing in your industry, and SoFi, your industry's really taken off in the student sector. I mean, numbers are remarkable in both of your companies. Where do you think you'll be in a year's time, and where do you think you'll be if interest rates go up? Are those yields going to go up? Well, the defaults go up?
From a kind of downturn perspective, I think that we're trying to identify borrowers that are particularly resilient in downturn. I think anecdotally, millennials are taking more jobs than their predecessor generations, and we think that it's easier for a 20-something to get a job in a downturn than it would be for, let's say, a 50-year-old. I think what we're trying to do is really one of the points Ron touched upon is build a brand that millennials our population can actually resonate with. So what's incredibly important for them is transparency, is trust, is fast and easy access and experience. And rate actually isn't that big a sensitivity point.
Okay.
So if rate comes important when you're wanting to check in the ballpark via Credit Karma, etc. But for us, what we're getting a huge amount of referrals is on the basis of the experience and the customer service.
Yeah.
So that's something, a big area for us to focus on over the next year.
And where do you think in terms of transaction flow? I mean, just talk us through how much have you done so far? How much do you think you'll get to in the next couple of years?
Well, our history's been slightly different because we launched with a very different product initially, more of a student debt product.
Yeah.
So we launched the loan business 6 weeks ago, and we've done $500,000 in 6 weeks.
Okay.
So, which is a nice start. We hope to do $2 million by the end of the year, and then we're lining up around $50 million for next year.
Okay, so big numbers. Ron, again, so obviously we can't get you to agree to Peter's big number there. But where do you think the sector's going, particularly if interest rates do go up?
Yeah, so I think what we all need to recognize as platforms, we need interest rates to go up. Because one of the things that's happening to all of us now is that our loans are being prepaid very, very fast. In fact, faster than many of us thought. So the duration on a 3-year term loan is really about 13 or 14 months. So if and when rates go up, people will refinance or pay off less, which gives each of us as platforms more opportunity to make money on the servicing strip of the loan. So let's not be afraid as an industry of rates going up. What has to happen at each of our platforms, to answer your question, is we have to know what to do to the risk model to iterate when rates go up, when unemployment goes up, and what to do as an industry when one of us has a data breach, when something happens in the industry. So I think we should be prepared for these things and really embrace them. But I think interest rates going up, the models will iterate, the gross returns might go up, the lower rated D, E, and HR categories might have higher defaults, but I think you'll see really good performance in that very top tier, the AA and A, even as rates go up.
Do you think, just on that point, because you've got oversight for this, that if interest rates go up and we see a slow but steady increase in defaults, that we could see the market never behaves rationally, particularly with, your very liquid securities, but they're not quite as liquid as you call your broker up and say, I want to sell your shares that second. Do you think that money could just flood out the sector and those actual net returns, even though defaults are going up, could shoot up? And actually, I've heard this said that actually the real sweet spot institutionally is when you have the first rate shock, and people just dump the class. Rates actually go quite nice. Actually, a good, really, really good rates of return. Is that the point I should maybe start buying in as an institutional investor?
It definitely could happen. If one of the platforms finds all of a sudden all their investors are gone or too many are gone, they may have to raise rates and go after different types of borrowers. For us, 1/3 of our platform is now the AA and A. These are the super prime, the 750 FICO making $100,000 a year. That used to be 5% of the platform, so that's now 1/3. So for us, we see as rates go up, that part of the book really won't be as affected as perhaps some of the
Okay, so that's maybe a good area to look.
Yeah.
Mike, again for you, where do you think you'll be in the next couple of years, and how do you think you'll cope with increased interest rates if they do happen?
So, for the better part of the last year, we hadn't had a very large investor appetite, and recently we closed a deal that gives us a substantial amount of money now to start originating loans. So last month we finished out with about $4 million in loan originations, which was approximately the same amount we had done up until last month. So we're pretty pleased with the growth and expect that this month it will start to increase. And, we have pretty high hopes. We expect that if you look back at where Lending Club and Prosper were in terms of where they were when they were doing 4 million, 8 million, 10 million per month, we expect to transition nicely into those numbers at a similar rate. In terms of interest rates going up, again, I think even if you start to see more defaults in some of the higher risk grades, we like to think that we've stressed those appropriately so we could withstand or at least preserve capital in those particular segments. And I agree with Ron about prepayment. And we look at prepayment risk very seriously because we think at least we've been able to identify certain pockets where we see prepayment already happening. And I think that as we move forward from a credit perspective, it's important to try and identify those and perhaps adjust the pricing within those groups, not to necessarily dissuade them from borrowing, but to at least offset the likelihood of prepayment and also offset the loss of income to the investors for those particular pockets.
One very last question for Peter. Crystal ball, what's the next new consumer product? Where do you think the really interesting stuff is? It students? Is it higher risk consumers? Where do you think what's really interesting you at the moment?
I think one of the most interesting places where this industry is going to go is guaranteed returns or insured returns.
Yeah.
You have it. I mean, even like partnering with an insurance company or something like that. Not just like the provision funds that are in the UK, but if someone can get like a 4% guaranteed return backed by a large insurance company, that's going to be compelling. People worry about all sorts of risks that will help mitigate that. And the other piece, obviously, is where we're going to go is a secondary market having liquidity. Liquidity is when we get a true robust secondary market, this industry is going to explode. We all think the growth here so far has been mediocre compared to what it will be then.
Thank you very much, gentlemen. If you've got any other questions for later on, please do send us questions. But in the meantime, thank you very much to our guests. Thank you.